Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, January 28th, 2022. Wanted to do a quick update on the equity markets, and I'll hit on a few other the commodities, precious metals as well. So we'll look at gold, silver, a couple other things, but not much. Mainly, I want to talk about the markets. This is where we're at right now. We still have those potential bear flag patterns, and if they're going to break sooner or later here because the flag is it's still symmetrical or in proportion, I should say, to the flagpole. What I mean by that, sometimes you consolidate too long and you have what I deem to be too big of a flag relative again to the scope of the flagpole. So those are still there, and on QQQ it's more of a pennant type shape. You have that bear pennant right there, and we need to see some downside, and so we're still consolidating, and again, that's the nature of a flag. I'm going to show you the 5-minute chart. Day trading has been as lucrative and as easy as I can remember it in some time now. Just I've been flipping the futures, long short, still holding core shorts in my longer term accounts, but in the active trading account, that's I'll show you a 5-minute chart here in a second. What's going on, but there's that flag right there, bear flag on the SPY, and again, if we break down, should take us down there to about that 400-ish level, 397 or so, and also down to the next target. So it should open the door for the deeper targets. Remember, on the SPY, I've really rolled now more toward the as far as price targets go, to the weekly. We've hit all my price targets on the the 60-minute chart that got us in short near the highs. I always say the 60 minutes you can use to hone down your entries and exits. And at this point in time, because we have some pretty decent sell signals, we'll still look out. But nothing's changed. We're still at T1. We've been there all week. We hit it earlier in the week, and we're still right there at my first target. And so, so far, the reaction off the initial tag at T1 has been one in with consolidation. I always say I define a reaction as a bounce and/or consolidation on that level, and to open the door, increase the odds for me to sharply say with confidence that we're gonna go down to T2 or even T3 or any of these targets down here, potential T4. Well, you got to take out T1. It's support. Support is support until unless broken. So far, that's how it looks there. And QQQ has yet to back test the 200s, other than the little consolidation we had around there. And SPY, as I mentioned, you had several opportunities to short it in the last few days, especially that 200-day simple moving average right up here, which has done a good job in recent months. And that's it. So let's not say any more on that. Now let's just go to the 5-minute charts. Again, it's just printing money for day trading lately. When you go in day trading mode, the thing with that is also you can take much larger position sizes because you don't have the overnight risk. And even then, sometimes I'll carry home a large position at night if in the futures, because they trade around the clock. So you can have a stop loss hit at 3 in the morning or a price target hit at 3 in the morning. So here's QQQs, what it looks like on the 60-minute chart. And these are all lines, levels I've been trading off of. We had a nice, clean, bullish falling wedge there. You also had the divergence that I like to look for. You broke out, so there was a buy signal, and you ripped up there. Then you had a secondary trend line right here that was hit. There's a breakout, ran right into resistance there, pull back. You have, you can see each of the lines, little minor trend lines, horizontal price resistance, divergences. That's the thing, guys. The takeaway is these divergences work exactly the same whether you're on a 1 or a 5-minute chart. We're looking at a 5-minute chart here, or a daily or weekly, even monthly chart. The difference is they play out a lot faster. When you're on a shorter time frame, you're on a 5-minute time frame, everything's in more like in fast forward mode. You get in, get out. Those are trades lasting minutes to hours usually, especially on a 5-minute chart. And on the weekly chart, those are trades that once a signal is triggered, on a solid weekly close below or above support or a bullish or bearish pattern, those are trades that typically last weeks or months. And so here's the most recent on the 5-minute chart. Nice divergent low. That's that textbook bullish falling wedge pattern right there, complete with positive divergence, and breakout today. and boom, right into resistance. So this is where, just turn around, you go long here. You can even see these wedges sometimes and almost, take like the cotton trade I gave you today. We're still within the wedge, and that's why I called it aggressive. I'll get to that in a second. So a lot of times I'll position in advance when you anticipate a breakout. You got a nice clean wedge and just take your, set your stops accordingly. But that's it. So we hit that level. Looks like even in the intraday chart here, could we be flagging there? So and the key is, as I said, use limit orders, sell, buy, sell, limit orders, OCO orders. If you walk away from your desk, an OCO order will say, let's say you're going to hold out for the flag to break out, and you got a reaction high up here that comes about in line with the measured target there, or even all the way up to that 354 level. Then you set a stop OCO, one cancels the other, stop a little bit below the flag right there, and your price target there. Or what I'd like to do too is trailing stops. You can trail stops up, and this is the QQQ. You can trade the Qs, or again, you're gonna trade if you're gonna leverage up. You might as well use the futures, in my opinion. And you can see this is the same 5-minute chart. I think I showed it to you the other day. Right there is that bullish falling wedge today that we had. Positive divergence at support as well. Look how many times we've come down here lately and hit that level. So there's a breakout right into resistance now. So therefore it favors, odds favor a pullback. The flag is not as distinct here as it is on that 5-minute chart of QQQ I just showed you. Probably come back in there. And again, it's tough because the weekend always does this. It's a cliffhanger. It's going to leave everyone guessing as to how to position. Now, this is all short-term stuff. You play around, flip the Qs in, out, long, short, long, short. But again, when it comes time to position for the weekend, because the thing about the futures, even they shut down on Friday afternoon after the market, after the end of this session. They trade a little longer, just like the after-hours trading. But the Globex futures will shut down and not pick up again until Sunday evening. So you'll have to, if you're either going to pick a side, you can go home flat. That's what I recommend a lot of people that don't know what to do or unsure. You can go home flat. And otherwise, you're going to have the potential for a gap up or down, even in the futures, because of that shutdown in trading at the end of the day. Here's a downtrend line on QQQ as well. So look, here's the bottom line. If the bulls have the opportunity, based on those 5-minute charts, we seem to be holding the top of the first target zone. Even though we hit the bottom of the first target zone, the top of the first target zone is really acting as support. You can see each and every one of these candles recently, other than the momentum fueled overshoot on the day we hit T1, the bottom of it. The bottom of all these candles have been around there, so that's really the level to watch. And again, it's what I just showed you on the 5-minute chart as well. It's not as well defined on QQQ because you don't see the round-the-clock trades, but I showed you that on NQ here. And again, so that's what we need to see. We need to see this level here go. What is that number? It's up right there. It's about 13,837 or so. That's what needs to go. So by the end of the day, if we turn around and they start dumping this into close, my guess is they're probably going to either, at worst, a marginal close, dip below that. At worst, again, I'm just guessing. This is short-term stuff. Well, charts will, be your guide. If it breaks this level, we're probably going to go up to the next area right there. That's be my next target, that reaction high. A little minor resistance there. Actually, yeah, that's resistance right there as well. But the way it works, if we reverse back down and we don't hold 14,152, we'll probably make a run at that. And so my guess is they're probably going to park it if they reverse this, fade this rally into the close today, and I think they will. Despite this little near-term rally, this is just technically induced. That's all this is. Traders don't know which way to go. Most traders, they don't know where this market's going. Investors don't know. They're trying to figure out, well, wow, earnings are so strong. Look at Apple, another blowout quarter. I mean, did you expect anything less from Apple? That's every quarter's a record quarter, just about, for that stock. But at the end of the day, well, the Fed's going to be raising rates, and Powell didn't really clear how much or how fast. He just said he would adapt to adjust to conditions. And so the market doesn't like uncertainty. The Fed put has, if not been completely removed, it's been lowered. What I mean by that is, when normally the market winds like it did, this little dip that we've had here, the Fed comes in and placates the baby, gives it more, puts more heroin in the bottle, more juice or whatever you're giving the baby, and in this case, of course, free money, low interest rates. But this time around, I feel confident we're going to go a lot lower. Employment numbers came in the hot right now today. The wage inflation up, I think, 4%. And I'll tell you, and I said this before, you want to keep this really easy, a guide to where the market's going to go, because everyone's wondering how fast and how much Fed's going to raise. Just pick a broad diversified commodity ETF like this one, GSG. It's well diversified. It has energy, agricultural, industrial metals, livestock, precious metals. If this keeps going up, this is the dot plot. The Fed doesn't know the dot plot. They're going to tell you, they're going to guess. I've said this before, and I'll tell you, if I feel strong about anything in the market, it's the fact that the Fed is reactive, not proactive, and often wrong. They have a history of causing bubbles and then turn around and reacting too late, too fast. So where I'm going is, okay, you want to know how fast and how much rates are going to go up. Watch something like this, a broad-based commodity fund. Unfortunately, the employment numbers, wage gains and all that kind of good stuff, that comes on an irregular basis, usually monthly reports and all that. But if you continue to see commodities going up, crude oil, food prices, things that are going to directly hurt the consumer, this is going to tell you how far and how fast rates are going to go. We have until March till the next meeting. Is it going to be just a quarter point, or is he going to come out with a 50? A 50 would certainly rock the markets. And what's going to happen? They'll talk about it. I'm talking about it now. They'll be talking about it right as you approach March. The futures the Fed fund futures will go up or down. You can track those too. It's just Google search Fed fund futures, and there's charts. They'll show you where they're at, and it'll show the probability of what the hike or what the rates will be at the next meeting, whether it's going to be a cut or hike. And again, now look, this goes the other way too. If all of a sudden you start seeing, let's say, oil and food prices, and the commodity prices come down, particularly the food, then that's going to help Powell. This is what Powell wants. He's probably down on bended knee right now, praying to see an abatement in food and energy prices. The housing market's going to cool once food finally does. I'm sorry, once the stock market does. But I'll get to lumber too in a second for you and see what that's telling you. But I did cover up my short position there. I told you I had a longer term target, but we hit one of my targets yesterday, and so I covered and actually reversed for a bounce on lumber. I'll get to that in 1 second. But anyways, just watch that, guys. That will, to a very large extent, influence how much and how fast we're going to see rates rise. Okay, at this point in time, it would take something big, a big shock to the markets for an intermeeting rate cut. So we'll just be watching for that March meeting, and we'll see where the Fed funds futures go, and that's going to impact where the stock market goes. Alrighty, next up, so there's your commodities. Let's talk about that. I mentioned commodities. Well, I'll segue into, I already segued into lumber, so let's talk about that. Alright, lumber, I gave it to you on a few different time frames. I've showed you the daily chart. I've had the 6-month chart. This was a short right here on the break of this uptrend line. Beautiful textbook bearish rising wedge, negative divergence, everything you want to see, right? And so yesterday we hit that 988 target right there, right? We overshot it a hair, but a couple things happened when we hit it. Number one, we were deeply oversold. This is the RSI here. That's not a misprint. This is 7.23. And that's the nature of this beast. What I mean by that? Well, RSI, I don't have the lines up. When you go to any brokerage program, any charting program, you're going to see typically they'll default lines at 70 and 30. 30 means oversold, 70 means overbought. Well, throw those lines in the garbage if you're trading lumber, because lumber, like natural gas, it's got two speeds or two directions, up and on full throttle and down. That's usually what it's doing, and that's why I love to trade it. Now you can get cuts both ways. If you're in the wrong side of the trade, then you got to use stops because this thing just was going down, 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 down every day. It's lock limit. Same thing on the way up. So it's a beautiful security to trade. But then you've got to look at conditions like this. Again, that is 7.7 on the RSI, and these are your extreme overbought readings right up here, and that's where it starts to get a little frothy. But in this case, you wouldn't ever sell or cover or reverse just on overbought or oversold, because if you got out every time you oversold here, you left a lot on the table, or if you shorted, then you got underwater. But what happens when I'll take all day long, you hit support, and from the entry there, we're down or profitable by about 26% into yesterday's lows, call it 25%. Okay, so I think the odds are decent for a bounce, and I still think we'll go on to hit my final target here, which is at 860, about 862 right there. I give you target zone, but it might look like this. And at this point in time, best to trail stops up, or even just again, do what you're going to do. I think it'll be hit if you're still short lumber. Keep in mind, again, you have that overnight risk on the weekend, a couple extra days and all that. But either way, you have a a bullish PPO crossover in conjunction with these overbought conditions. And so that just can't make a case to stay short unless I get a bounce back up into here, that 1100 level, and then try to swing that last leg down if the charts confirm it at the time. In other words, that's the 60-minute or the hourly 2-hour candle chart. This is our candle right here, 60-minute candle. So you get a little trend line right there that's also been popped. There was your divergence and all that. The divergence was carrying over from a long time ago. I just showed you on the 2-hour chart, and there's the PPO turning up. And again, so maybe something along these lines. So we could speak to, and the reason I kind of segued into this when I was talking about inflation, maybe it speaks to what's going on in the housing market. I mean, it certainly doesn't show overwhelming demand when lumber drops 25%, but in the big picture, let me grab that for you. This is the big picture, daily chart of lumber futures, continuous contract. Again, you look for these things like the divergent low right there, and you have the rally, and you get waves going up, but again, they're powerful corrections, powerful rallies. Just from this last bottom there, rallied 125%. As I showed you, we got in here short because we broke this trend line. There's that same wedge. We just were zooming in on the 60 and 2-hour chart. But there's that drop right there. And again, this is where I think we're coming down to. It's just a matter of probably get a little, oversold blip. You get those blips along the way, and then the trend resumes. So, okay, point I was trying to make is, if we continue down, especially if we take out that low, that's telling me that home builders aren't buying as much lumber. That's showing they're seeing order cancellations, pull back. Remember, it's all tied into interest rates. Dr. Feelgood's taking away the heroin right now, or it's talking about it. Again, I think he's doing way too little, way too slow, as I think some others do as well. In other words, he should have already been raising rates. All he's doing right now is talking about raising rates. It's ridiculous. It's insane with the way inflation is right now. But whatever, that's his job. My job is just to trade it, and that's what I'll do. TLT. These are the long bond here, and it's still at support. Showed you it was at support the other day, and if it can break this trend line, it's probably going to go up. 60-minute chart looks like this. We had a couple divergent lows right here, and we're still holding off those divergent lows right there. So that's a 60-minute chart, and I'm talking about this because here's ZB, the 30-year bond. And so if this breaks out, there's a downtrend line, you have a little bit of resistance there, and then another resistance level there, about 157.094. The more we see rates come up, And I'm just standing inside the bond trade because there's a mixed signal. The Fed's also unwinding their bond purchases, so it's hard to say which. There's a lot of technical and fundamental cross currents right now. Technicals show this. Technicals look like we're going to rally here. We've already been moving up a little bit. That would mean falling rates, and that would help the housing market. But again, if the stock market drops, I know I'm all over the place here. So if these bonds break out, you're going to see an abatement in rates. But what we've seen lately is, bond prices have been falling. This is inverse to rates. I'm probably confusing you. So if we can rally here, that's going to help longer term rates, going to help mortgage rates, or it should. But if the problem is, if this rallies, these are Treasury bonds. That, well, quite likely is also going to coincide with weakness in the stock market, a flight to safety trade, and more so than rates. Much more importantly, in my opinion, especially where house prices are right now, is the wealth effect. So anyway, I'm showing you where the charts are. They're looking bullish near term, looking like a rally in rates and Treasury bond prices. When I say that the rates are inverse, so you have TYX is the 30-year yield. So this is where the long bond's yielding, and a lot of times the mortgages are going to respond as much or more to the 10-year. Believe it or not, even if you do a 30-year mortgage, that's usually what a lot of traders will track, or people in the mortgage market. But there it is. We're at resistance right now. We're pinched. We're going to go one way or another, and so you break down here, yields go down. That's good for the housing market. If the yields break out, remember again, the Fed's unwinding their bond holdings. A breakout in yields and much higher rates, that's going to really dampen the housing market, which in turn would also dampen the stock market. Wealth effects tied in. Those are our two biggest. Keep talking about those too. Your stock portfolio, and generally speaking, your stock portfolio, your investments, and your home are most people. It's the majority of their net worth, what they have in their house and what they have in their 401k or savings. And so there's another line there I wanted to add to that chart. So here's what I'm watching, guys, and I know there's kind of all over the place because there is, we do this. What does it mean? Again, the takeaway is yes, rising rates are going to hurt the housing market. And so that might also play into lumber, where lumber prices are going. And if we look at, I told you that's the 30-year, we can go to the 10-year and see where we're at there. And on the 10-year, same thing. You have the 10 years pushing highs. You have some divergence in place. So the yields look like here, they look like yields are going to go down near term. And that would coincide with those bullish charts I just showed you on the bond futures. And again, bond prices go up when yields drop. So there you have negative divergence. You have a breakout, but it's a marginal breakout right here, and it could fail. I tried to box it in, and if it does fail, we could head on back down there. I got one more level. I need to really start looking at this. All right, there's 1527, and here's what it looks like on the weekly. So you can see the weekly is quite bearish for yields, and that's bullish for bonds. So just wanted to kind of go over all that, and I'll continue to update these. They're certainly worth watching, even if you don't trade them. I made that comment the other day. Somebody said, "Oh, the euro. I don't know how you were bullish on the euro." Look, last update I did a week ago, I think it was, said, "Look, here's a euro." And I'm going to show you the same thing on gold here in a second. It's in a triangle. Triangle patterns can go either way, and this one broke to the downside. And then when it broke to the downside, we still had price support there. That was taken out too. So this is I'm going to segue into gold here now that I'm on the euro. So that breakdown saw nothing but selling, and of course the Fed's certainly going to be raising rates, and they're more as dovish as Powell is, he's more hawkish than the ECB. So again, these currencies, it's really a race to the bottom. But what you do have now, and I'd be remiss not to point it out, you have some big divergence there. Bullish divergence. So we had the breakdown, and that's a heck of a move. In fact, that's one of the biggest moves in a while in the euro. But you're coming down to support as well on the weekly chart. This was a big zone right here. You have quite a few lines. There's a support line right there that the euro's traded off of. PPO looks like it wants to turn up, and we're oversold here on the weekly chart. The last time we actually hit it, we never got there. That was not oversold. That didn't hit it either. This was the last time the euro was oversold, the euro US dollar pair. Right there when it first got down there, and then we put in that big divergent low right there. But even before the lower low for the divergent low, you had a couple big bounces here. So that's the thing. It's like pushing on a string. Yeah, it's the U.S. Is the dollar stronger because we're going to see higher rates sooner than the ECB? Yeah, but how much of that's already been priced in? So, and again, remember the whole point of covering the euro is that I'm not a big forex trader. Occasionally I'll take a dollar or a euro trade and trade futures, but I mainly chart it just to uh, get a feel for where gold's going, because there's a clear impact over time in a direct correlation. In other words, the euro and gold move positively correlated because the euro and the dollar are inversely correlated. And the reason I say this all the time, but I know there's new people that come in the site, so I hate to be repetitive. It's simple. This is not some magical, wow, why was that? The gold that we're trading, at least I'm trading GC gold futures, or sometimes some of you guys are trading GLD, the ETF, and that is priced in US dollars. So if you freeze supply and demand, and you have the dollar parity. Let's say right now the dollar, we'll just say, is at $1, and a gold was $1. We'll just say $1 an ounce. Keep it very simple, okay? And all of a sudden the dollar drops 10%, right? And we go down to 90 cents because there's a 10% drop in the dollar. So now the dollar has fallen. It takes more dollars to buy an ounce of gold. So therefore, a falling dollar causes the price of gold to go up. Again, if you can freeze supply and demand. So if in a vacuum it was perfect, there was equally matched buyers and sellers, a falling dollar, if the dollar fell 50%, it's going to take twice as many dollars to buy an ounce of gold. So the price of gold would double. And so that's why that correlation exists. Now, and what I said in that post the other day, I view this as bullish. Does gold come down lately? Yeah, the charts indicated that. There were some divergences on the 60-minute chart, so it was up against resistance. But what you can see here is normally, this is the euro right here. Normally, when the euro falls, gold's falling as well. The euro bottoms and gold rallies. Here was a strong rally in gold, and the euro fell. That was very bullish. This was back, by the way, 2018, 2019. This shows overwhelming demand. This is saying that even though the euro was falling and the dollar was rallying, which should have brought gold down, gold still rose, and that's simply because then you had overwhelming supply-demand forces. Much more people buying than selling it, much more people wanting to be in gold. And, again, the fact that the euro has tanked recently, just plummeted, this is a euro down here, and the gold has actually held up, it to me is net bullish. And at first, gold was falling and the euro was falling, but lately on this last slide, gold has held up. So that shows, I view that as constructive. In other words, on a relative performance basis, the gold is outperforming. And now let's just roll into that. So here's gold. This chart I know is so busy. I'm just going to show you the key levels. Way back, to kind of talk about the bull market, if you will, in gold. Back here, way back here, we have to go back to the weekly chart. Excuse me. Gold bottomed in late 2015, and it was all out bullish on it then, and real bullish once it finally broke this level here. This was a big one for me back then, 130. So that was where the bear market ended. A new bull market started, but we went sideways for a few years, really, right here, and then finally, right there, that was the magic moment. That was the breakout above 130, and it made clear to all, in case some thought maybe this was bear market consolidation, that we were in a new bull market and had a basing pattern right here in gold. Really, all this right here was a basing pattern in gold, and then boom, a breakout, right? That's a bull market. And so this I'm viewing, and there's the perfect triangle pattern. I've been highlighting this for months. We need to break above that, and if we break above it, solid break should I believe set gold off in the next leg up in a bull market. Should it break to the downside, maybe the bull ended right here and we're going to go a lot lower if it's anything more than a brief whipsaw. But that's where we are. So if you're frustrated because you're a long-term investor, and gold's gone pretty much nowhere now for the last year plus, well, first of all, there were a lot of signs and reasons to get out there, but right now, this is the nature of a triangle pattern. But triangle pattern, unlike a sideways trading range or a price channel, gets tighter and tighter and tighter, and that is energy building like a coiled spring, just like what just happened to the euro. The euro broke to the downside, so respect it. If you're a gold bug, longer term bullish on gold like I am, I wouldn't call myself a gold bug because you guys know me. If you followed me for a long time, I am equally as comfortable and will short gold and the gold mining stocks in bear trends when they break down. Right now, it's just been a hit and run situation for gold. That's where the trades have been, just quick in and out swing trading ops. So back here, okay, when we peak back here, I laid out a buy zone all the way back then. That was in 2020, and said this would be the buy zone for long-term investors, myself, scaling back into long-term positions. We hit the bottom of it twice, and then you can see here, and I know it's messy, but there's the bottom of the triangle. I've got another blue line up there that's messing things up. So there's our big triangle pattern. And we're coming close to the bottom of it now. We're not all the way there, and we also have price support. So it looks to me like the downside right now is minimal in gold, and especially if that euro gets a bounce here, that should be net bullish for gold. Finally, we'll look at the futures, but the problem is on my futures, the charts I had it charted, they just rolled it. My platform from the March to the April contracts. In the March, all my trend lines and annotation go away. That chart just goes away. So I don't have that chart marked up. I still have. They haven't taken my silver away yet. They haven't rolled that one. But there's the divergent high I was talking about. That's what happened in gold. And this is that rally in the euro with Powell coming out and making it pretty clear there's going to be rate hikes. So again, swing trading mode. You just hit and run, look for these divergent lows, which are bullish. Look to go long, catch that trend, and you get the divergent high, you get a correction. But now we're coming up to support. You have a previous reaction low right here. And you can also draw a trend line, the one I just showed you on the daily chart, which we're coming up on. So maybe a little more downside. But even for a swing trade, you could start scaling in now down to, but not much below, I'd say. I've got some price support there as well. So I'd say from here down to about 1761 or 1760 right there. Silver, let's see if I do still have that chart for you. Yep, here's silver futures, 2-hour candles, 6 months price history. Same thing, simple stuff. Swing these divergent high. That was a divergent high right there. See that? Divergence, boom, downtrend. Divergent low, bullish, boom, uptrend. Divergent high, bearish. And of course, trend line breaks. Those are your buy and sell signals, not simply the divergence. Downtrend. Divergent low at support, as highlighted at the time. Bullish. Boom. Uptrend. Hit that 24,707 resistance right there, and showed you that gold had the negative divergence, and then also pointed out a trend line here, which could have held but didn't hold. And that's again the Fed. This is all what happened with the Fed, and the dollar rallying and the euro sinking. But it's taken silver back to support with even better support down here. So to just keep it very simple, this from where we're at now, 22,313 down to about 21,48. That's your buy zone right there. If you want to swing for the next leg up. You also have a very steep downtrend line right there. What you would do if I see a trend line that or such a steep advance, I zoom in a little tighter, step it down to the next time frame, or even you can go down to a 15-minute chart if you want. Give yourself a nice little steep downtrend line there. Look at that little on the 60-minute. We've got a little bit of bullish divergence forming. It's potential. It's not confirmed, but should it play out, that would give you a nice trade there. And again, we're getting quite oversold in the metals here. This is a 60-minute chart. I'm going to put a line about where we're at right now. We're just coming off this 20 level right here. Let's see what happened the last time we hit it was right here. You wanted to be long silver. You hit it here, and then you came back near there, and you had that, of course, a positive divergence. And then, boom, had a rally. And then you hit it right here in a strong downtrend, but you still had a tradable bounce right there to play. Okay, next up, cotton. I shared that on the homepage today, and I made a correction to that homepage post. I had mistakenly referred to the chart of CT cotton futures that I posted. There's a 60-minute chart when in fact it was a daily chart. This is the daily chart. I did follow up in the comment section, gave you the 60-minute chart, which I'll go over in just a second here. But this is the long-term chart right here, long-term uptrend line, like just about every other commodity in a bull market. Hence the reason I said it was objective, because I'm sorry. Hence the reason I said it was aggressive. You're shorting something in a strong bull market. That in itself is aggressive, and all we had was a minor trend line break. I showed you on one of the charts here. This is the uptrend line that we need to see go, and it did. It just went on the daily chart, negative divergence. We're having a little snapback rally here, which is a result of a breakout on the 60-minute chart I'll get to in a second. But these are the targets I maintain. I think it'll play out something like that. Head down, hit T1, which is the intersecting uptrend line in 1.0254, and then that the final target there. And that's going to be about a 25% drop if my second target's hit. When we step down to the intraday charts, the hourly chart, here's what happened. You had a little triangle pattern right here. You had a downtrend line there on the 60-minute chart, and you have a uptrend line right here that actually goes all the way back to there. But that shows you this little triangle here, and you pop the triangle. So we're probably going to come up, back test this line right here, and then go down. And then you can swing these targets if you want just short-term targets. 118.47, 114.65, and then the daily T1's all the way down here. So that's what that looks like. And again, aggressive because it's in an uptrend, and this is what happens. So you're going to need to see this level go here, the 60-minute chart, that uptrend line, and then that 118.47 level go. Once that goes, I think it'll happen it'll start to build up some downside momentum. And I gave you the ETN for those of you that don't trade futures, and this is it. So there's your uptrend line, there's your a divergence line, which gives you a bearish rising wedge on this daily chart, and there's that minor uptrend line, and that's why I said it was objective, albeit aggressive, because you need to break this larger, more significant trend line here on BAL, and then that should take you down. T1 63.85, T2 58.25, and T3 53.60. Remember, these are unadjusted targets, meaning the actual support level. I would highly suggest, even if you don't trade futures and you're going to short this one, you want to use the charts of the futures to be your guide when to get out. What I mean by that, well, if you get down to T1 or close to T2 and then the futures hit support, the futures are more important. This ETN, like all commodity ETNs, are tracking the futures. They're trying to roll them, but it's imperfect. They have slippage and all kinds of fees and costs to roll those futures. And so the futures are the real deal. That's what the professionals are trading. And if my point being, if you get down close to a level, but the futures have hit a comparable support or trend line, horizontal price support or trend line, that's where, and that is your target, assuming that's where you want to cover. Otherwise, you can just sit tight, ride out the counter trend bounces, and go for the big prize. And this does a pretty decent job. A lot of these ETNs, they're not perfect, but they do a pretty good job. I showed you on the daily chart of the futures, my downside target was about 25% drop. Here it's about 23.43%, so close enough. So they're roughly in line, the price targets and the amount down. So and take that into account. Again, every trade you need to have a plan. You only want a quick pullback because you're saying, Randy, it's in a bull market. I'm not going to go for a 25% pullback. I like that T2. I think that's going to be hit. Well, if that's the case, you're talking about a 16% drop. So you might consider maybe a 5-6% stop loss, give you that roughly 3-to-1 RR. However, if you're going to go down and hold out and you're targeting that 24 or 5% drop, then yeah, you can give yourself an 8% stop loss, maybe even 9%, and because that will help keep you in the trade and still give you an attractive risk reward. In other words, don't risk $1 to make $1. Risk $1 to make $2, $3, $4. That's the idea. We'll wrap it up here. I could go on and on, talk about every single commodity out there. The other one that's been moving lately is natural gas. Everything going on in Ukraine. There's worries that Europe wants some assurances, maybe help from the U.S. If the natural gas pipeline supplies are shut off, if any kind of military action heats up over there, that the U.S. will help supply. So of course, if that's the case, then it's going to put pressure on increased demand. So this shot up. The only thing I saw here, I did point out we had nice on the last update on UNG, big divergent low right there, positive divergence, and it worked. We got a rally, we had a pullback, and I talked about it was a trade idea. Then we broke above that, break out of there, then we pulled back, and then I mentioned it as an objective long and a pullback to 1321. But this bounce was it was technically induced from that point, but this is fundamental. Now, where we're at right now, we're have resistance at 17, and we're almost there. Then at 18. So I think most of that runs over. Yeah, these are old targets from before. 17, 14, we're coming right up to resistance. If we reverse soon, we're going to have negative divergence. And let me see if I have my futures. If I see anything marked up there, I have two of them. I have the March, and then let's look at no, they're both March. I thought I rolled these. Either way, that was the trend line right there. It was taken out recently. That was a breakout right there. There was a support at 3.362, and boom, it's just been going up and up. But you're coming up on some reaction highs right there, so probably not a lot of meat left on the bone on that one. Nor did I highlight this most recent move. I just wanted to update for those of you wondering what's going on with the big move in natural gas and where it might go. All right, that is it. Yep, covered Treasury bonds, gold, a couple commodities, and the markets. So as I leave it here, we'll just go back to those 5-minute charts I started with. There's a little minor uptrend line on SPY. One thing I like to use in this histogram to identify turns. The histogram's pointing down. We don't yet have a bearish cross, but if you break that trend line, we might not get up to that next resistance level in SPY, 439. Again, weekend's coming, so now is probably as good enough time as any to just lighten up, take home with you what you want to take home over the weekend. Like I said, I think the charts at this point in time still favor being short based on those flags. And again, you can go home flat, and maybe if we do break down, you'll have an opportunity to jump in, but you could also gap way down. If you go home too heavy short, we could just pop up and foil the flags. There's no guarantee they have to play out. I'm sorry, and I've already given you my bounce target range. I've covered that quite a bit lately, and that was from the other day when we were at the 200-day up to 450 on SPY, and then on QQQ. Like I said, it's not as well defined, the levels there, but there's pretty important resistance right here at about 360. So if we happen to pop and foil the flags, that's going to be pretty good resistance. Anything much above there, you still have the 200s right above it. So the 200s would be really where I'd scale up to in QQQ and kind of hold off if they punch right through there, because there might be something more going on. But if and when that happens, I'll let you know. Right now, leaning towards this and still think it's worth going home into the weekend short, in my opinion. This has been Randy Finney with Right Side of the Chart. Have a great day.